There are five things sitting inside your financial world right now that the IRS is going to tax the second you walk away from work. Not because you made a mistake, but because of where those assets are sitting. And the time you have left to reposition them is shrinking faster than most people understand. The video with 3.6 million views that exploded online last year told you to sell your house, sell your vehicle, sell your belongings before you retire. That is personal lifestyle guidance. It is perfectly fine, but it will not save you one single dollar in taxes. What I am about to walk you through are five specific financial positions that the IRS handles differently depending on whether you reorganize them before your final paycheck or after it. The gap in actual dollars is six figures across a 25-year retirement, not theoretically, but mathematically. If you are within 5 years of stepping away from work, this is the most critical tax video you will sit through this entire year. Here is the reason why. Every single one of these five strategies becomes dramatically more costly or entirely out of reach once you stop earning a paycheck. The tax brackets shift, the income flexibility vanishes, the IRMA look back locks in permanently. And by the time most retirees figure out what they should have done differently, that window has already closed completely. Before I walk through any of this, I need to make something very clear. I am not an attorney. I am not a CPA. I am not a licensed financial advisor. Nothing you hear in this video is legal, tax, or investment advice. These are educational illustrations grounded in current tax law and publicly accessible IRS information. Always work with a qualified tax professional before acting on anything related to your personal financial situation. My name is Nancy, and if you are brand new here, welcome to Senior Tips USA. This channel exists for one very specific audience, retirees and pre-retirees over 60 who want to understand how the IRS truly functions during retirement. Not the version your HR department handed you, not the version your financial advisor glossed right over. The real version with real numbers explained in plain everyday language. If that describes you, hit subscribe right now. Because next week, Senior Tips USA is releasing a video on the exact month you should retire to minimize your tax burden. That one is going to shift the timeline for a lot of you. Drop a comment right now. How many years until you retire? Just write the number 1, 3, 5, 10, whatever it is. I personally read every comment, and the most common number is going to determine which of these five strategies I cover in a complete deep dive next. 2 seconds. Go do it now. Let us get into it. Number one, sell your high turnover mutual funds inside your taxable brokerage account. This is the one that quietly drains people for decades without them ever noticing. If you currently own actively managed mutual funds inside a taxable brokerage account, not inside an IRA, not inside a 401k, but in a standard taxable account, those funds are producing taxable events every single year, whether or not you ever sell a single share. Here is exactly how it works. The portfolio manager inside your mutual fund is constantly buying and selling stocks. Every time they close out a winning position, that transaction creates a capital gain. At year end, the fund distributes those gains directly to you. You owe taxes on them even though you personally never sold anything. You never received the cash. You never made a single choice. But the IRS delivers a 1099 to your mailbox and you owe the bill. High turnover funds can carry turnover rates of 80 to 120% annually. That means the entire portfolio is being replaced within a single year. Every single replacement generates a taxable event. The tax burden of holding a high turnover fund compared to a low turnover index ETF inside a taxable account can amount to 1 to 2% of your balance per year in completely avoidable taxes. On a $200,000 taxable account, that translates to $2,000 to $4,000 per year in taxes you never needed to pay. Over a decade, that is $20,000 to $40,000. And you likely never caught it because the tax appeared as one line item on your return, not as a bill arriving with a red warning stamp. The solution is straightforward, but it must happen before you retire. While you are still employed, your income is elevated enough that you are already sitting inside a higher bracket. The capital gains from liquidating the mutual fund positions and purchasing tax-efficient ETFs will be taxed at your current long-term capital gains rate, either 15 or 20% depending on your bracket. But here is the critical piece. In 2026, the 0% long-term capital gains rate applies to single filers with taxable income under $49,450 and married couples under $98,900. If you hold off until after retirement and your income falls into that range, you can harvest those gains at 0% federal tax. Absolutely zero. So the approach is this. If you are still employed, begin transitioning high turnover mutual funds into tax efficient index ETFs now, but execute it gradually. Liquidate the positions with smaller gains first. Hold the positions carrying large embedded gains until your first full retirement year when your income drops, and you can potentially harvest those gains at 0%. Either way, every year those high turnover funds remain in your taxable account is another year of unnecessary tax drag. Remove them now. And let me walk through the mechanics specifically because people consistently get this wrong. When you sell a mutual fund and purchase an ETF, there is no wash sale rule violation as long as the ETF is not substantially identical to the fund you sold. For instance, selling an actively managed large cap growth fund and purchasing a total stock market index ETF is completely acceptable. They are distinct investments. The wash sale rule only comes into play when you sell at a loss and repurchase a substantially identical security within 30 days. If you are selling at a gain, the wash sale rule has no application whatsoever. A viewer reached out to Senior Tips USA last month, who had been holding a high turnover international fund in his taxable account for 12 full years. He had never examined the tax drag. When he finally gathered his 1099s covering the past 5 years and totaled up the capital gain distributions he had been taxed on, the figure exceeded $11,000 in taxes paid on gains he never personally chose to realize. $11,000 gone simply because of where the fund was sitting. He transitioned it to an index ETF in a single afternoon. The bleeding stopped immediately. The IRS does not consider whether you intended to generate those gains. The fund manager made the trades, and you pay the taxes. That is precisely why this must be corrected before retirement. Because after retirement, every dollar of unnecessary ordinary income pushes your Social Security into a higher taxation zone and can activate IRMA surcharges. The compounding cost of unnecessary income during retirement is substantially worse than that same income while you are still working. Number two, sell your traditional IRA balance. By that I mean, convert it to a Roth. Senior Tips USA has discussed Roth conversions on this channel numerous times, but in the context of actions to take before retiring, this is the single most powerful financial move available to you. And the math is so undeniable that you need to hear it one more time. Every dollar sitting in your traditional IRA is a dollar the IRS has not yet taxed. They are going to collect their share eventually. The only question is when and at what rate. If you take no action, those dollars remain in the traditional IRA. They grow and compound, and at age 73, the IRS requires you to begin pulling them out through required minimum distributions. By that point, the account is larger, the forced withdrawals are bigger, and every dollar that comes out is taxed as ordinary income stacked on top of your Social Security and any pension income. The effective tax rate applied to those RMD dollars can reach 30 to 40% when you account for the Social Security taxation cascade and ERMEA surcharges. The alternative is converting a portion of that traditional IRA into a Roth before retiring or during the first several years afterward. The period between your last paycheck and age 73 represents what we call the gap years. During those years, your income sits at its lowest point. You are no longer drawing a salary. You may not yet be receiving Social Security. Your RMDs have not yet begun. In 2026, a married couple filing jointly can fill the 12% bracket with roughly $133,000 of taxable income. If your only income during the gap years comes from controlled IRA withdrawals, you have enormous room to convert at 12% rather than 22% or higher later. Let me attach a real number to this. A couple who converts $300,000 across 5 gap years at 12% pays approximately $36,000 in federal taxes on those conversions. That identical $300,000 left inside the traditional IRA and forced out as RMDs at an effective rate of 25% over 20 years costs them $75,000. The conversion saves $39,000 on the exact same money. But here is what makes this firmly a before you retire move. While you are still employed, your salary fills up the 12% bracket entirely. There is no space for conversions at reduced rates. Every conversion dollar gets stacked directly on top of your salary and taxed at 22% or higher. Your final year of work is far too late for substantial conversions. You need to plan the timing so the gap years begin precisely when your salary stops arriving. If you are within 3 years of retirement, speak with a tax planner this month, not next year, this month. Because Roth conversion planning requires modeling multiple years of income exposure alongside Social Security timing, and it simply cannot be completed in April when your tax return is already due. And there is one additional layer to this that almost no one explains clearly. If you are between 60 and 63 years old in 2026, the IRS recently established a new super catch-up contribution rule. You can now contribute up to $11,250 in additional catch-up contributions to your 401k, bringing your total employee contribution ceiling to $35,000 per year. That sounds appealing on the surface, more money going in. But if your prior year wages exceeded $150,000, those catch up contributions must be directed into the Roth side of your 401k rather than the pre tax side. You are paying taxes on that money right now at your highest working bracket. Here is why this matters for your pre retirement planning at Senior Tips USA. Congress is essentially pushing high earners over 60 to make Roth contributions at 22% or higher when they could instead retire and convert at 12% during the gap years. The system is nudging you to place money into the Roth bucket at the most expensive possible rate. The only way to outmaneuver it is to plan your exit timing carefully so the gap years open as quickly as possible and you can convert at rates that genuinely make financial sense. There is also the IRA interaction to consider. Every dollar you convert from a traditional IRA to a Roth counts as income for IRMA purposes. The 2-year look-back means a conversion executed in 2026 can spike your Medicare premiums all the way in 2028. For single filers, the first IRMA tier begins at $109,000. For married couples, it begins at $218,000. If you are executing conversions, you need to model the IRMA tiers year by year to confirm you are not saving $12,000 in income tax while simultaneously spending $4,000 in elevated Medicare premiums. The math still typically favors the conversion, but you need complete visibility into the full cost before you execute. Did you already know about the gap years? Drop yes or no in the comments below. I am genuinely curious because this is the concept that completely reshapes people's entire retirement timeline, and I want to know how many of you are encountering it for the first time right now. Number 3, sell your appreciated stock at 0% capital gains while the opportunity still exists. This one connects to number 1, but it is an entirely separate strategy. In 2026, if your taxable income falls below $49,450 as a single filer or $98,900 as a married couple, you pay 0% federal tax on long-term capital gains. Absolutely zero. That means if you hold individual stocks or ETFs inside your taxable brokerage account that have appreciated considerably, you can sell them, owe no federal capital gains tax whatsoever, and immediately repurchase them. You have just reset your cost basis to the current market value. When you eventually sell those positions again, years down the road, the gain is calculated from the new elevated basis. You eliminated years of embedded gains without paying a single penny in tax. This strategy is called capital gains harvesting. It is the mirror image of tax loss harvesting. Rather than selling losing positions to offset gains, you are selling winning positions when your income is low enough to pay zero on the gain. But here is precisely why it must happen before or immediately following retirement. The 0% rate only applies when your taxable income remains beneath the threshold. Once Social Security begins, once RMDs activate, once your pension starts flowing, your taxable income climbs above the threshold and the window shuts permanently. For the majority of retirees, the 0% capital gains window exists for only 3 to 5 years at most. Some individuals have an even shorter window than that. If you purchased a stock 20 years ago for $10,000 and it is currently worth $60,000, that represents $50,000 in embedded gains. Selling it while your income qualifies for the 0% rate saves you $7,500 in federal taxes compared to selling it later at 15%. That is on a single position. If you hold multiple positions carrying embedded gains, the savings compounds substantially. Your final year of employment and your first 2 to 3 years of retirement represent the sweet spot for this move. After that point, the window is typically gone forever. Let me give you a concrete illustration so you can visualize the full scale of this opportunity. A married couple retires in January of 2027. During 2027, their only income is $30,000 from controlled IRA withdrawals. Their taxable income, after the standard deduction of $3,300, is effectively negative. They sit comfortably below the $98,900 0% threshold. They hold three stock positions inside their taxable account. Position A has a cost basis of $15,000, a current value of $40,000, and an embedded gain of $25,000. Position B has a cost basis of $8,000, a current value of $22,000, and an embedded gain of $14,000. Position C has a cost basis of $20,000, a current value of $35,000, and an embedded gain of $15,000. Their total embedded gains equal $54,000. They sell all three positions. Total capital gains equal $54,000. Federal tax at 0% equals zero. They immediately purchase similar but not identical ETFs using the proceeds. Their new cost basis equals the current market value. If they sell those same positions a decade later when their income has climbed higher, the gain will be calculated from the new elevated basis. They just erased $54,000 in future taxable gains without paying a single penny. Had they waited until age 75 to liquidate those positions, when their RMDs and Social Security are driving their income above the threshold, the 15% capital gains rate would have cost them $8,100 in federal taxes on that identical $54,000 in gains. That is $8,100 preserved simply by selling 2 years earlier. And one important clarification: unlike tax loss harvesting, capital gains harvesting carries no wash sale restriction. The wash sale rule applies exclusively to losses. You can sell and immediately repurchase the identical security. However, most advisors suggest purchasing a similar but not identical fund to ensure the transaction is cleanly documented as a separate acquisition for cost basis tracking purposes. Number 4, move your bond funds and REITs out of your taxable account. This is fundamentally about asset location, not asset allocation. That distinction matters enormously, and almost no one gets it right. Asset allocation refers to what percentage of your total portfolio is invested in stocks versus bonds. Asset location refers to which type of account those investments actually reside in. And the IRS treats different account types in dramatically different ways. Bond interest is taxed as ordinary income. REIT dividends are also taxed as ordinary income. If those investments are sitting inside your taxable brokerage account, every dollar of interest and every dollar of dividends gets added directly to your adjusted gross income. That additional income pushes your provisional income upward, which in turn pushes more of your Social Security into the taxable zone. It can activate IRMA surcharges. It increases your state tax liability. The identical bond fund or REIT sitting inside your traditional IRA generates the exact same income, but you pay no taxes on it until the moment you withdraw. Inside a Roth IRA, you never pay taxes on that income at all. The strategy itself is clean and simple. Before you retire, sell your bond funds and REITs out of your taxable account. Purchase them inside your IRA or Roth IRA instead. Inside the taxable account, hold tax-efficient index stock ETFs that produce primarily long-term capital gains, which are taxed at reduced rates or potentially 0%. The dollar impact of proper asset location can equal 1/2 to 1% of your total portfolio value annually in reduced taxes. On a $500,000 portfolio, that translates to $2,500 to $5,000 per year. 5,000 dealer. Across a 25-year retirement, that is $62,500 to $125,000 saved simply by moving the same exact investments between different account types. The allocation does not change, the risk profile does not change, only the tax bill changes, and it changes dramatically. Why execute this before retirement? Because while you are still working and actively contributing to your 401k or IRA, you have natural incoming cash flow to use for purchasing bonds and REITs inside the tax-sheltered account. After you retire, those contributions stop entirely. You would need to sell and repurchase positions, which can itself trigger additional taxable events. It is cleaner and far less expensive to establish the correct location while money is still actively flowing in. If you have stayed with Senior Tips USA this far into the video, you are precisely the kind of person this channel was created to serve. Hit the like button right now. It takes 1 second, and it signals to YouTube to show this content to more pre-retirees who genuinely need to hear it before their window closes. And if you have not yet subscribed to Senior Tips USA, do it now. The video coming next week on the optimal month to retire is going to save some of you thousands of dollars in unnecessary taxes. Number 5, sell your high tax state residency. I understand that relocating sounds extreme, but the actual math is not extreme at all. It is completely straightforward, and for some of you, it represents the single largest financial decision of your entire retirement. 9 states currently have no state income tax whatsoever. Those states are Florida, Texas, Tennessee, Nevada, Wyoming, South Dakota, Alaska, New Hampshire, and Washington. 3 additional states, Pennsylvania, Illinois, and Mississippi, do collect income tax but fully exempt all pension and retirement income. That means IRA withdrawals, 401k distributions, pension payments, and Social Security benefits are all completely state tax-free. Compare that to California, where retirement income faces taxation at rates reaching 9.3%, or New York, where everything above $20,000 in pension income is fully subject to tax, or Minnesota, which continues to tax a portion of Social Security benefits at the state level, or Connecticut, which gradually eliminates its Social Security exemption for single filers above $75,000. For a retiree generating $60,000 in annual retirement income, the difference between living in California versus Florida amounts to roughly $3,500 to $4,500 per year in state taxes alone. Across a 25-year retirement, that totals $87,500 to $112,500. That is not a lifestyle preference. That is a financial decision carrying a 6-figure consequence. But here's precisely why this move must happen before retirement, or immediately at the point of retirement. Many states enforce residency rules requiring you to establish legal domicile, update your voter registration, obtain a new driver's license, and spend the majority of each calendar year physically present in the new state. If you delay until age 73 when your RMDs are pushing your income higher, you are paying the elevated state tax rate for every single year you waited. Each year of delay costs you the complete annual difference. Senior Tips USA published a full video ranking the 3 worst and 3 best states for retirees specifically. If your current state is costing you significantly, go watch that one immediately after this video concludes. And here is one final layer that almost no one is currently connecting. The $6,000 senior bonus deduction established through the One Big Beautiful Bill is a federal deduction. It reduces your federal taxable income by $6,000 per person, or $12,000 for a married couple, covering tax years 2025 through 2028. But if you reside in a state that conforms to the federal tax code, that deduction also flows through and reduces your state taxable income simultaneously. In states like California that begin their calculation with federal AGI, the senior deduction carries through and generates savings at the state level as well. But if you are already living in a state with no income tax, the federal deduction is everything you receive. And that still translates to $440 per year for a couple sitting in the 12% bracket. The point Senior Tips USA wants you to understand is that the state residency decision interacts directly with every other move on this entire list. If you relocate to Tennessee and execute Roth conversions at 12% during your gap years, those conversions cost you absolutely nothing in state tax. In California, those identical conversions would be taxed at the state level on top of the federal rate. The effective rate of a Roth conversion in California can reach 21 to 23% when you combine federal and state taxation together. In Tennessee, it sits at 12% flat. The difference on a $100,000 conversion is $9,000 to $11,000 on a single conversion in a single calendar year. Senior Tips USA is not instructing everyone to relocate. If your entire family is in California and your grandchildren live in New York, and everything meaningful in your life is built in Minnesota, do not dismantle your entire existence purely to reduce your tax bill. But if you are already contemplating a move, If warmer weather or a lower cost of living is already on your mind, add the tax calculation to your decision making process. For many of you, it will be the factor that finally tips the scale. Now, let Senior Tips USA bring all five of these together through one unified example. Picture a married couple, both age 63. They hold $400,000 inside a traditional 401k, $150,000 inside a taxable brokerage account, and they currently reside in California. Their plan is to retire at age 65. Move one, they sell their high turnover mutual funds in the taxable account and replace them with tax efficient index ETFs. Annual tax drag eliminated equals approximately $2,000 per year. Lifetime savings over 25 years equals $50,000. Move two, they begin executing Roth conversions during their first full year of retirement. They convert $50,000 per year for 5 consecutive years at 12% instead of waiting for RMDs taxed at 22% or higher. Tax savings on those conversions equals approximately $25,000 across 5 years. Move three, during their first retirement year, when income drops substantially, they harvest $60,000 in embedded capital gains at 0%. Total tax avoided equals $9,000. Move four, they reposition their bond allocation from the taxable account into the IRA. Annual tax savings from corrected asset location equals approximately $2,000 per year. Lifetime savings over 25 years equals $50,000. Move five, they relocate from California to Tennessee at the moment of retirement. Annual state tax savings equal approximately $4,000. Lifetime savings over 25 years equal $100,000. Total estimated lifetime savings across all five moves combined equals approximately $234,000. Same couple, same money, same retirement. $234,000 more remaining in their own pocket because they restructured five specific financial positions before the window permanently closed. And here is the part that should genuinely concern you if you have not yet taken any of these steps. Every single one of these moves is completely legal. Every single one is thoroughly documented within the tax code. The IRS places no restrictions on any of them, but the IRS also does not volunteer that they exist. Nobody contacts you at age 63 to say you really ought to consider converting your IRA before your gap years come to an end. Nobody delivers a notice explaining that your mutual funds are silently draining $2,000 annually in unnecessary tax drag. Nobody alerts you that your bond funds are sitting in the wrong account type. The system is structured to collect the maximum possible amount from individuals who never think to ask these questions. These five moves are the questions you should be asking. Here is exactly what Senior Tips USA wants you to do right now. 3 specific things. First, open your taxable brokerage account. Review what you currently own. Are there high turnover mutual funds in there? Are there bond funds or REITs generating ordinary income year after year? Those represent positions 1 and 4 on this list. Address them immediately. Second, look at your total traditional IRA or 401k balance. If it exceeds $200,000, you need a Roth conversion strategy established before you retire. That is position 2. Engage a fee-only tax planner. Not next year, this year. Third, determine your embedded capital gains. Review the cost basis of everything you hold in your taxable account. If substantial gains exist and you are within 2 years of retirement, map out the harvest for your first low-income year in retirement. That is position 3. The 0% window does not remain open for long. Drop a comment and tell Senior Tips USA which of the 5 moves surprised you the most. Simply write the number 1 through 5. That response tells us precisely what to cover next, and the most common answer becomes next week's complete deep dive video. If this content delivered value for you, hit like. Subscribe to Senior Tips USA if you have not already done so. We release videos like this every single week. And the next one, the video covering the optimal month to retire, is going to shift the retirement timeline for a meaningful number of you watching right now.